Hello and welcome to the Innovation Women Speak webinar series. My name is Bobby Carlton. I'm the founder of Innovation Women, and welcome to the latest in our webinar series. The Innovation Women Speaks webinar series features our speakers. So if you need awesome speakers who just happen to be women, you can go to innovationwomen.com and find those. For those of you who are new to Innovation Women, one of the things that we do is connect event managers and speakers. So we are an online visibility platform for awesome women, professional women, entrepreneurial women, technical women, and we connect them with event managers who are looking for speakers. If you join Innovation Women, these are all the great things that you get from our service. So today, if you're interested in learning more about Innovation Women, you can sign up for our weekly newsletter, or if you're interested in joining us, use the Innovation Women code for our webinars. That's IWWebinar. It's 20% off for the first year, so that's only $80 to join us. And that is good until midnight tonight, or if you want to get real specific, 11:59. So before I turn things over to our guest speaker today, I'd just like to review a few logistics on the platform so you know how to use it. So starting off on the left-hand side, you see an annotated version of your screen. Below the video viewing window, there are some tabs. The default tab is for asking questions. You can type in a question at any point during the program, and we'll answer it either during the question and answer period, or if it's something specific, I'll alert our guest speaker and we'll jump right in on it. The next tab over is called Rate. This enables you to rate the webinar and provide feedback to us if you'd like. We actually read all of the feedback, and it's been really helpful in improving our webinars. So feel free to give us any feedback you like. And at any time, if you need audio help, feel free to click on the Help button at the bottom of the screen. If you're using your phone to dial in, you'll need to mute your computer audio. Actually, if you want to test out that question thing, feel free to drop in the information on who you are, where you're calling from or where you're calling in from today, and if there's anything in specific that you want to know from this webinar. That would be terrific. So today's speaker is Rashida Motawala, and she is going to be talking to us about the new tax law and how it affects you. This is key tax reform for businesses and individuals explained. She's going to explain the changes that have been implemented for 2018 that will affect us all. And I have to tell you, as a small business person myself, I'm very interested in this topic, let me tell you. So I'm going to turn things over to Rashida. And I just wanted to let everyone know that she is a certified public accountant. She works with clients from various sectors, helping them strategize financial models to achieve their company and individual goals, help them stay in compliance with tax filings, manage wealth transfer and philanthropic strategies, maintaining efficient cash management, and tightening internal controls. She's worked as the CFO of a startup company, managing their accounting and operational needs, and she's an adjunct professor at University of Massachusetts. So, why don't you take things away, Rashida? Thanks for joining us.
Thank you, Bobby, for the great introduction. Good afternoon, everyone. Thank you for taking the time out of your busy schedules to listen to a dry subject such as taxes. I understand that this is not an exciting topic for most of you or many of you, and I will try my best to keep it simple and informative and pass along some tax tips as we go through the subject matter here, as well as try to answer any questions that you might have towards the end of the presentation. So as most of you know, on December 22nd, 2017, The most sweeping tax legislation was enacted since 1986. The Tax Cuts and Jobs Act, as I will refer to during my presentation as TCJA, has made small reductions to income tax rates for most individual tax brackets, however, significantly reducing the income tax rate for corporations. This act has also brought about changes to substantial changes, I would say, to owners of pass-through entities and small business owners. Some changes that have been enacted by this new law have been put into the law permanently, while other changes are provisions that will expire at the end of 2025. Some of the changes that are going to expire at the end of 2025 are referred to as temporary changes, and these mostly primarily affect individuals and trusts. The income tax brackets for individuals, as you can see on the screen, have been left into the 7 categories. However, there have been slight changes to the rates and income brackets that have been put into the 7 brackets. The 7 brackets range from 10% to 37%. The top rate for single filers and joint filers, respectively, being 500,000 and 600,000. So what that means necessarily is you will be in the topmost 10 tax bracket, i.e. 37%, when you have reached $500,000 of income if you're a single filer, or $600,000 if you're a married filing joint return. We're going to review some of the individual changes or changes that affect individual tax filers first, followed by tax law changes that is going to impact businesses. So first and foremost, the change that everybody's talking about is losing out completely on the personal exemption and doubling of the standard deduction. So the Act suspends completely the personal exemptions that used to be around $4,000 per person up until last year, and I'm rounding some of these numbers instead of mentioning some exact amounts for you, just to keep it simple. However, they have doubled the standard deduction to equal $12,000 for a single filer and $24,000 for a married filing joint individual. For some of the taxpayers, the increase in the standard deduction will compensate for the elimination of the exemptions. Sometimes some of the tax filers are even coming ahead of the game with some additional tax savings. However, if you are a filer that had many dependents or who had large items coming through your itemized deductions list in the past, some of these changes will actually impact you in a negative way and produce a higher tax bill. There are some surprises that many of our tax filers are seeing. At the end of 18, some of the returns that have gone through my office are seeing good surprises where they're happily surprised to receive a greater tax saving than they were expecting, and some vice versa, not so. Child tax credit. Child tax credit is raised quite a bit since the previous years to $2,000 per child. The child for this, in order to claim this credit, needs to be under the age of 17, and a portion of this credit, $1,400 of this credit, is even refundable if you have no tax liability at the end of the year. A new credit that has been introduced this year is the non-child credit, which is introduced for dependents who are not necessarily qualifying for the child tax credit. This could be a child over the age of 17 years old, because they wouldn't then qualify for the child tax credit, or an elderly parent if you're taking care of one. And that credit is equal to $500. You will see that alimony contracts that were put into effect after December 31st, 2018, is affected by the new tax law. So if your divorce agreement was executed anytime after that date, after December 31st, 2018, payers will no longer be able to deduct alimony payments, and recipients will no longer have to include alimony payments in your tax returns. This is probably going to be a bigger tax bite than some expected, only because most generally the recipient spouse was at in a lower tax bracket. The payer was in a higher tax bracket, so them not being able to deduct alimony payments anymore will mean them essentially paying more taxes than they were before. This change is a permanent change as opposed to some changes that are temporary. If you have an alimony agreement or a divorce agreement that has been in place since before December 31st, 2018, this new law will not apply to you. There has been a change to exclusion of moving expense reimbursements from income. Unless you were an active duty member of the armed force, if you have been reimbursed for moving expenses by your employer, you will no longer be able to exclude this going 2018 and forward. However, if you had a move where the move happened in 2017, however, your employer did not reimburse you until 2018, you will be able to exclude that moving expense for year 2018. However, going forward, that exclusion is completely eliminated. AMT exemptions. What is AMT? Many people have heard of AMT in the past, but they don't exactly know what AMT is. I'm going to try and briefly explain AMT here. I'm not going to be able to go into the details of, unfortunately, too many of these descriptions, only in the interest of time, and also would like to save some time towards the end of the seminar for the audience to ask me questions. So giving you a brief background, AMT is almost a second tax system. So the words AMT stand for Alternative Minimum Tax. It is a second tax system that computes the tax on a different tax rate and a different income threshold completely. So you have your regular income tax, you have your AMT tax. Both of them are calculated side by side. AMT tax is calculated at a 26% and a 28% tax rate. In the past, about 5 million taxpayers were expected to pay AMT. When I say in the past, I mean in years prior to 2018. Going forward, because of the tax law changes that have been put into effect, only 200,000 as compared to the 5 million before are expected to pay AMT in 2018. And this is because the AMT exemption amount was significantly increased in 2018. For 18, the AMT exemption amount for a married filing joint is $109,400, whereas it used to be $84,000 in 17. Income levels for the filers at which the exemptions phase out have also been increased significantly. For married filing joint couples, this income phase out used to be in 17, $160,900, where now it is $1 million for married filing joint and $500,000 for other taxpayers. Um, 529 plans. What are 529 plans? 529 plan distributions are used to paying qualifying education expenses. This used to be the case only for college educations. However, from 2018 onwards, you are able to use 529 plans to pay for primary and secondary school expenses as well as religious school expenses. There is a limitation, however, for amounts that are used for K through 12 schools, homeschooling expenses, or religious schools, and that limitation is up to $10,000 per child annually. There are no limitations, there are no maximum limitations for college education. 529 plans are also now able to be used for ABLE plans. ABLE plans are plans that are put into place for the benefit of qualified disabled individuals. The transfer of money from 529 plans to ABLE accounts will be limited to the annual contribution limits, and that annual contribution limit changes every year. The limit for that for 2018 is $14,000. Kiddie taxes. I'm sure some of you are familiar with the kiddie taxes. However, for those of you who are not, kiddie taxes apply to unearned income or investment income of children under the age of 18 or to children who are full-time students and are between the age of 19 to 23. So if you have had a child with unearned income over $2,100 and your child qualifies, meaning the child has to fall between the age groups that were specified, and you must have provided more than half the support for your child, then kiddie tax rules will apply to your child. The new act has actually made kiddie taxes even harsher than they used to be before. Why? Because now the child's unearned income is going to be taxed at the tax rates that are applicable to trusts and estates. So putting this into perspective, trusts and estates, the highest marginal rate for a trust and estate is 37%. So once your child reaches the income level of that kind of respectively follows that 37% for a trust and estate, which is a much lower income bracket than what an individual will be, your child will end up paying a higher rate on their unearned income than what the parent would be paying. Some tips over here to keep your kiddie taxes under control is to invest in municipal bonds that generate interest that are tax-free at the federal level, although they might be taxed at the state level. You could also invest in U.S. savings bonds, which are federal tax exempt, however, would be taxable at the state level. Some other pieces to keep in mind as far as kiddie tax is concerned, try to plan to put in monies under your children's name as far as investments go, so that you can take the maximum benefit of the child's standard deduction or take the benefit of the income that is tax-free to a child. So the first $1,050 of unearned income is not taxable to a child. So you may want to take maximum advantage of that amount. Or a child, once the child goes beyond the $1,050, will fall in the single taxpayer's child tax rate. You may want to take maximum advantage of the standard deduction that is applicable to a child so that you could save as much as possible on the kiddie taxes. The individual mandate penalty of the Affordable Care Act that used to be in place up until now is going to be repealed for tax years after 2018. So for 2018, you're still required to have health insurance, and if you don't, in the absence of which you will incur a penalty on your tax returns. But after 2018, you will not be penalized for not having health insurance. Moving on to itemized deductions. There have been quite a few changes to the itemized deductions. The first one on the list is mortgage interest deductions. You might have heard of this only because most of you have home mortgages or debts. And the change that has been put into effect for this is the new act allows the taxpayer to deduct interest only on mortgage debt of up to $750,000. However, this limit is grandfathered. If you have a loan that was in place or a mortgage debt was in place before December 15, 2017, then you are grandfathered into the old law, in which case your limit remains to be $1 million for most filers. Unless you are single or married filing separate, your limits are lower than that. Home equity interest deductions. In the old law, prior to 2018, you are allowed to have your home mortgage debt, which was on your primary residence, and you were able to have one additional loan, which was your home equity debt, which you could have taken out for any kind of personal expenses or to make improvements to your existing home. Under the new law, you are supposed to not only be having a cap on the limitation, a cap or a limitation on the amount of your debt that you have, either for your mortgage or of your main residence or your second home, you're also restricted to the use of the monies that you borrow from this new loan. The monies are supposed to be used for either buying or building your main residence or your second home, or to make any substantial improvements to your home. If you have not used your money for the set purposes, then you're not able to deduct these interests any longer. There has been a cap on the deduction of state and local income taxes, which includes your real estate tax, state income tax, and property taxes. This has affected a larger population of the public than probably Congress expected it to, and this is probably one of the reasons that many of the taxpayers are seeing a surprise in their tax bills this year, where they thought they were going to save on the taxes, but they haven't. And that's mainly because most of the taxpayers are paying much more than $10,000 when they add up their state income taxes, their local excise taxes, property taxes, and real estate taxes. If you are a single or a married filing joint taxpayer, you're limited to only deduct $10,000. The rest of the amounts paid in taxes, you are not able to deduct in this year or able to carry forward to any future year. If you are married filing separate, then that limitation is $5,000 to you. Medical expenses are only deductible if they increase above 7.5% of your adjusted gross income for 2018. This has not changed from 17. It has been the same. You can only deduct medical expenses in excess of 7.5% of your AGI for both 17 and 18. After 18, this threshold is going to change to 10%, which means you can only deduct medical expenses in excess of 10% of your AGI, which generally, in simple words, means you will get less of a deduction for your medical expenses. Drastic changes to miscellaneous itemized deductions that used to be subject to the 2% floor in years 2017 and prior. Some of these deductions, just to refresh your memory, were related to fees paid to legal professionals or tax professionals for preparing your tax returns, or for estate planning purposes, the fees that were paid to your legal counsels. Investment expenses, meaning the brokerage fees that you pay to investment brokers to manage your investment accounts, are no longer deductible. Unreimbursed out-of-pocket employee business expenses that were captured under the miscellaneous itemized deductions are no longer deductible. This also has affected a large subsection of the population. Personal casualty and theft losses are now only deductible if you are in the federally declared disaster zone. If you have a normal personal casualty and theft loss, you can not deduct it anymore. Professional gamblers are able to deduct their losses only up to the winnings that they've had in that year. Moving on to charitable contributions. Charitable contributions AGI limit has increased to 60% for 2018, which necessarily means that if you have charitable contributions more than 60% of your AGI, AGI here again means adjusted gross income, you are not able to deduct it. Some other changes that have come to charitable contributions section is, and not everybody that is coming to my office has been informed of this, and we are trying our best to inform them, is that IRS has become more stricter and tighter with what kind of records you can maintain to prove your charitable contributions. So you're required to have more contemporaneous records for your contributions. If you had made charitable contributions in excess of $250 cash or check, you are no longer able to satisfy this IRS requirement by proving them that you made the charitable contribution by giving them a copy of a canceled check. That's no longer acceptable by itself. So you also need, in addition to the canceled check, an acknowledgement from the organization that received your charity. If you are making non-cash contributions in excess of $500, where you just leave like a bag of clothing or other household items for Salvation Army to pick up, and you going and dropping it in the box for Salvation Army or any other charitable organization, you are now required to have a receipt from the charitable organization that lists the items that you donated to them. You can't just take a blank receipt and use that to prove that you made your non-cash contribution if it was in excess of $500. I guess that brings us to the business tax section for today. That was all that I had that would impact individual taxes, and moving on to business taxes. Overall, most of the companies, corporations, when I say companies here, I mean, have seen a significant reduction to their tax rate. So the tax rate for corporations has moved now down to a flat rate of 21%. This also applies to personal service corporations such as my firm, which is set up. Many of these professional service corporations used to have a much higher rate. They used to be at a rate of 35% in the past. They also are now at the 21% low corporate tax rate. The corporate AMT has been completely eliminated. The AMT used to be at a 20% rate for certain corporations, which has now been completely eliminated. There is a new deduction that has been introduced that has been the talk of the town ever since December 2017, which is the 20% deduction that is effectively given to small business owners, sole proprietors, and pass-through entities. With pass-through entities, what used to happen, or what still even happens, is the net taxable income that is generated at the pass-through entity level essentially is passed through to the individual owners and then taxed at their individual tax rate. Because the lower corporate rate was introduced and given to the corporations and personal service corporations, the government thought maybe we should share something equivalent or something similar to pass-through entities, so we don't have one section of the business community upset or angry at us, and that's why they introduced the 20% QBI deduction. We'll talk a lot in lot more detail in a couple slides from now, so I'm not going to go over some of the details right now. But just so you know, that's one of the changes that has been introduced to the business community. Section 179, expensing. I'm sure everybody is familiar with the Section 179 expensing. what Section 179 does is allows you to deduct either an entire cost of your qualifying purchase in the first year, or if not entire, most of it. Section 179 has always been around. It's not a new introduction. What Section 179 was to do when it was introduced initially was to encourage small and medium-sized companies to invest in equipment, software, or other tangible goods. Every year, there is a limitation that is provided for deduction of Section 179 expensing. The limitation has been substantially increased in 2018 to let you deduct in the first year of acquisition of qualified expenses $1 million of your expenses. This $1 million deduction is phased out once you have spent $2.5 million in those qualified expenses. After you reach $3.5 million, you will completely lose any Section 179 deduction. A new introduction this year also has been to increase the bonus depreciation for certain eligible property to 100%. In prior years, this deduction was limited to 50%. What this really means is if you have purchased and put into service property after September 27, 2017, and before January 1, 2023, you are eligible to take 100% of the bonus depreciation deduction. Bonus depreciation deduction used to be available only to new assets, new purchases, meaning if you bought a used vehicle or a used equipment, bonus was not available to you. From 2018, the change that has been brought into effect is bonus depreciation is now going to be eligible for a used or a new asset. The only requirement is that the asset needs to be new to the tax owner, meaning you could buy a used vehicle as long as it's new to you, you are able to take bonus depreciation. There are certain other limitations that are applicable to the deduction of the 179 expense and the bonus depreciation. Some of those are the Section 179 expense cannot create a net operating loss. What that means is you cannot have more Section 179 than you have income for your business. However, bonus depreciation can create an NOL. So you could have a loss in a particular year and still take bonus depreciation beyond your taxable income. That is one of the main differences. Some things that have changed with respect to qualified improvement property that impacts the bonus depreciation is bonus depreciation is only eligible to be taken for assets that have a life of 20 years or more. Qualified improvement property, because of some technical changes that were incorrectly put into the tax law, and what I mean by that is when the Congress was rushing to put the new tax law into effect by December 22nd, 2017, they had a drafting error. And what that drafting error did was they left the qualified improvement property to be capitalized as a 39-year asset. And what that did was you are not able to take any bonus depreciation for qualified improvement property because the life of those assets is more than 20 years. However, there's some good news for Section 179 deduction because there are certain qualified improvement properties like improvements that were put into effect to HVAC units, roof, which were not eligible, and certain other permanent leasehold improvements that were not eligible for deducting the 179 expenses now qualify to take the 179 expenses. Some new higher deduction limits have been introduced for business vehicles, and this is something that might impact many small business owners. So annual depreciation limits for business vehicles have significantly been raised. For example, for new and used vehicles with a gross weight of 6,000 pounds or less, which is most of the passenger vehicles that are not large SUVs, that were acquired and placed in service in 2018 and are used more than 50% of the time for business use, in the first year can now deduct up to a maximum of $10,000 under regular depreciation, or 179. So Section 179 will still be limited to the regular depreciation maximum limits. If you are taking the bonus depreciation for the automobile, you can add another $8,000 to the $10,000 in year one of your acquisition. Year 2, year 3, and year 4 have also similarly seen much significant increase in the maximum limits that you're able to take for the business vehicles as compared to 2017 and before. This is going to come as good news to some small business owners who were on the fence of whether I should buy that expensive SUV or vehicle or not. The maximum limitation for vehicles between 6,000 pounds and 14,000 pounds, so this is for your heavy-duty SUVs, is $25,000 in year one. If you have a vehicle that's over 14,000 pounds, which probably affects a very small subsection of the population, not too many of you, there's no maximum limit, but I thought I'll say it out there just in case there's any of you thinking of buying any such vehicle. There has been some changes to deductions of net interest expenses for businesses. Under the Pre-Tcja law, when I say TCJA, I mean Tax Cuts and Jobs Act law, the interest that was paid or accrued by a business was fully deductible. For the new law, which is implemented in 18 and the future, the business interest deduction is limited to 30% of the adjusted taxable income of the business. So if your business interest is more than 30% of your taxable income, you're no longer able to deduct it in that year. You will have to carry it forward. You can carry it forward indefinitely. There's no limitation to how many years you can carry it forward to. This limitation or change applies to corporations and pass-through entities. For pass-through entities, this limit is applied at the entity level, not at the owner level like it is for the other pass-through entity regulations. However, there are some exceptions to the deduction of the business interest. These exceptions are smaller businesses. What I mean by smaller businesses are if you are a business with an average annual gross receipt of $25 million or less for the past 3 previous tax years prior to the current year, you do not fall under this category, which means that you can still have 100% business interest deduction. Some other exceptions to this rule are utility companies, dealers, car dealerships, and those businesses that deal in real property, which means that some businesses that deal in real property are required to use a slower depreciation system. Those businesses will be exempt from following the new limitation of the business interest expense deduction. There have been changes to entertainment expense deduction. This also has been a heavily discussed topic. There used to be a deduction available for meals and entertainment. Meals and entertainment usually went along hand in hand of 50% of meals and entertainment that was available for 2017 and before. Going forward, entertainment expenses will be no longer deductible. So if you have tickets to Patriots games or box seats for the Patriots games that your company buys every year and expenses through their business expenses, they will no longer be able to deduct that. Meal expenses are still eligible to be deducted at a 50% level. However, there's a disallowance of that 50% to meals that used to be provided by employers for the employer's convenience on the employer's premises to their employees used to be eligible for 100% deduction. Now they're going to be eligible for a 50% deduction. So these are some of the changes that have taken place to the entertainment and meals section. Net operating losses used to be able to be carried back 2 years and carried forward for 15 years. Now, the net operating loss carried back has been completely eliminated, and the carry forward remains indefinitely. The carry forward of the net operating loss, even though it remains indefinite, you can only take up to 80% of the net operating loss in any given year to wipe off your current year taxable income. So a tax tip here that goes along with the NOL and deduction of bonus depreciations or Section 179 depreciation that we discussed earlier is try not to create too much net operating loss in a given year, because now you are not able to take the entire NOL to wipe off. You are only able to take 80% of the NOL to wipe off your current year taxable income. So as an advice, I would not take Section 179 deductions any more than I have to. So if I feel that in the future years I'm going to have more taxable income than the current year, I would not exhaust my entire 179 deduction, because it is up to you whether you want to take the 179 deduction in a current year or you don't. You're not required to take the 179 deduction. So if you purchase a new asset, you can opt to depreciate that asset in its normal course of time, over its normal life, which is 5 years, 7 years, 10 years, whatever is applicable to that particular asset. You're not required to write it all off under Section 179. If you think you're going to have future taxable years for your business, I would depreciate that asset in its due course rather than take 179. And as far as bonus depreciation, you can write off 100% of that asset if it qualifies in the year of purchase. However, if it creates an NOL, even though bonus depreciation allows you to do that, I would not suggest doing that, only because in the future years, you're only limited to using 80% of that NOL, not 100% as it used to be in the previous years. So I would make a note of that as you are thinking through your using of the higher depreciation deduction amounts for your business asset purchases. The other change that has been brought into for cash basis of tax reporting for those businesses that had inventory accounting. The eligibility rules for this have become more flexible, which means that if you are an entity, small to mid-sized entity, that has cost of goods sold and inventory accounting, you're no longer required to use the cash basis. And who is that small business or medium-sized business? If your average gross receipts over the last 3 years are under $25 million, then you qualify as a small to mid-sized business, and you're no longer required to use cash basis of accounting, meaning you could use accrual basis of accounting. Moving on to the next slide. I think this is the last section of our webinar today, and this is about the QBI. So I left the QBI to be at the very end only because This QBI, although it seems very simple at the onset and user-friendly, is a very complex rule, and some of the criteria that have been put into effect for this is even very complicated for tax preparers, let alone having the tax filers or business owners sieve through this mess and understanding what the government is trying to put through here. So I have some definitions on the slide on the right, which you see in the beige or the grayed out section, and some of the methods as to how the QBI functions on the left of the slide. So what is QBI? QBI is Qualified Business Income. That's what the abbreviation stands for. The QBI deduction equals 20% of your qualified business income. So the new law provides this to individuals, estates, and trusts. QBI is given to an individual, meaning if you're a sole proprietor, or if you are an individual that has income earned through a pass-through entity. A pass-through entity is an S corporation, a partnership, a sole proprietorship, or a disregarded entity. So if you are under any one of these categories, QBI is available to you. For taxpayers that are affected by the QBI, what you need to do is, it's easiest if you break this up into separate sections. The first thing that you need to do is determine whether your trade or business is a qualified trade or business. So one thing, I just need to go back a little bit before I go into some of these steps. I do want to just point out that C corporations are not eligible for the QBI. Keep in mind what I said in my previous slides. Because the tax law brought into effect the lower tax rate for the corporations, they felt compelled to giving something to the pass-through entities as well. They thought by giving the QBI deduction, they will kind of be bringing the pass-through entities at a similar level as the C Corps. It's not necessarily the same level, but they were trying to give some sort of a deduction to the pass-through entities. So QBI is not available to the C corporations. Keep that in mind. The first step that I would recommend everybody does is determine whether your business is qualified or not. There are certain trades or businesses that are completely disqualified once they reach a certain income level. The second step is whether you are going to be affected by Tier 2 and 3 of the calculation of the QBI, which is whether wages that are given by your businesses or whether you have fixed assets in your business impacts you or not. For taxpayers whose taxable income does not exceed $157,500 for a single, or $315,000 if you are a married filing joint filer, the deduction is fixed at 20% without any limitations. Once your taxable income increases above $207,500 for a single filer or $415,000 for a joint filer, you will have to qualify, or two other limitations will apply to you, which I'm going to move to my next slide to show you. The other two limitations that apply to you are the wage limitations and, the wage limitations that I'm just pointing out, which is here. You need to have wages in your business to be able to qualify for the deduction once you are in this tier. Once you reach Tier 3, which is if you are over $207,500 for a single filer or $415,000 for a joint filer, and you are in the qualified business, then you will be phasing out of some of your exemptions that you qualified for in tiers 1 and 2. Keep in mind, specified service businesses, which are businesses that are involved in the performance of services provided in the health industry, law industry, meaning doctors, lawyers, consultants, athletes, tax preparers such as myself, financial services, brokerage services, all of these businesses fall under the specified service, trade, or business. Those that fall under a specified service, trade, or business start phasing out of this deduction once they reach the level 2 and level 3, as I'm pointing to my slide here. If you are in level 1, the topmost slide here, which is if your income is below these threshold amounts, then you are eligible to get the 20% deduction even if you are in the specified trade or business. You will start losing out of your deductions once you reach level 2, if you are in the specified trade or business, and you completely lose out of the deduction once you are in level 3. And what determines whether you are in level 1, 2, or 3 is whether your taxable income falls within any of these 3 tiers. I think that is the end of my slide. I know the QBI explanation or the calculation is not very straightforward for most of you. However, some of the regulations that have to do with the QBI are still being tweaked by the government, let alone tax preparers and tax filers that have to sort through the mess that has been created in December of 2017. So with that said, I think I'm all done with my spiel today, and I go back to Bobby to take it on from here.
Yeah, thanks a lot. We're going to start right off with some questions. So if you have specific questions, feel free to enter those now. We already have a few people that have put in questions. So I'm going to start us right off with a question from Vicki from Florida. She's looking for resources for nonprofit taxes. And Rashida, if this is not an area you're focused on, maybe you can recommend some resources?
I think if Vicki can email me after the seminar, I can probably go ahead and answer some specific questions that she might have about nonprofit taxes and guide her in the right direction, if that's okay.
Great. Okay. The next question is, who qualifies for child tax credit?
Okay. So child tax credit is given to children under 16 years of age. This age is determined at the end of the tax year or the calendar year that you're filing the tax return for. If you as a parent has income for a married filing joint return under $400,000, you will have the eligibility to take advantage of the child tax credit. If you had a child that you provided at least half of the child's support for the tax year, if the child lived with you for at least half of that year, if the child did not file a joint return, meaning if your child was not married and filing a joint return with somebody else, and falls within those age restrictions. However, keep in mind, to be eligible for the child tax credit, your child must have a social security number. There are certain children who have ITINs instead of social security numbers. They're not eligible to qualify for the child tax credit. If you have not your own child, but a niece or nephew or a grandchild that qualifies under some of these provisions mentioned earlier, who is your dependent, he or she will also qualify for the child tax credit.
Okay, that sounds great. The next question is, what changes in the 2018 tax laws will affect homeowners?
Okay. Good question. As many of our clients have come back with questions regarding that, and some of this I've touched upon in one of the slides before, but one of the main tax law changes that have affected homeowners is the changes to the deduction of the home mortgage and equity interest and the limitation to the property tax deduction. So there is a limitation on the amount of the debt that you can have. There is a restriction to the use of the monies that you have borrowed via one of these debts, and also the lack of deductibility of the taxes that you have paid as real estate taxes that makes home ownership actually more expensive than it used to be for Americans. So what you need to have done is, for tax years 2018 through 2025, home mortgage interest paid during the tax year is typically, as everyone knows, deducted under the itemized deductions on Schedule A for your 1040. This debt that you take for your home mortgage, or it should be either for your primary residence or your secondary home. That's it. You cannot have a third or a fourth home that you take the debt for. The debt that you take for either one of these residences must be used to either buy, build, or substantially improve your primary residence or your secondary home. The second restriction that has been put into place is the debt must be secured by your primary residence or your secondary home, and the debt must not exceed $750,000. If your debt satisfies all of these conditions, then you can deduct the interest on that loan or debt. If your debt amount is more than $750,000, then you can deduct the interest up to $750,000. So you don't lose out completely from the mortgage interest deduction, but your mortgage interest has to be prorated and will be limited to deducting up to $750,000. Also keep in mind here, if you take a loan or a debt by securing your primary residence for the debt, however, you use the funds for your secondary home, which is your vacation home, you will make the interest on that debt ineligible. Because for you to be able to deduct that interest, you need to not only stay within the dollar limitations of the debt, but you need to secure the debt by the same property that it is being used on. So if you are going to use the funds that you take from the borrowed money on the primary residence, then secure it by that house. If you're going to use the funds by securing your second home or your vacation home, then you will be restricted to using the funds to improve or build or acquire a second home. Do not interchange the monies borrowed between the two homes, otherwise you'll make yourself ineligible.
Okay.
You also need to remember real quick here that if you have an old loan that was put into effect before December 15, 2017, then you will be grandfathered into the old rules that were in existence to 2017 and before.
Gotcha.
And you can take it from here, Bobby.
So it sounds like a good thing that I don't take vacations and I don't have a vacation home to spend money on.
I guess so, huh? One way of looking at it.
Also sounds like I need a business vehicle and no more parties. So, thank you so much for that. That was great information. And if you are interested in joining Innovation Women in our speaker series, our next speaker series is featuring Kristen Tyrell, and she is going to be talking about behavioral economics and the savings crisis. That will be on March 20th, 2019. Again, a lunch and learn for our East Coast folks. And you'll be talking about managing your safety net and how it's gotten harder, having enough money set aside for emergencies, saving for retirement, and even getting the right insurance is confusing and expensive. So why is that? We're going to be hearing about that from Kristen Tyrell. So thank you again for joining Innovation Women on the Innovation Women Speak Speaker Series. If you're interested in being one of our speakers, go to innovationwomen.com and you can use IW Seminar, all in caps, for webinar, not IW Webinar, all in capital letters for 20% off through the rest of today, right up until midnight. And if you're looking for awesome speakers who just happen to be women, innovationwomen.com. Thanks for joining us.